to join us as well. So just in 3 minutes, in 3 minutes, we should basically start. Sit back and enjoy the webinar. Yeah, okay. So it's 10 minutes past 5 p.m. West African time. As a matter of introduction, my name is Justice Upong. I will be your anchor for today's webinar. Um, as you can see, it's a webinar around financial modeling, and at the core of this webinar is timing flag. So timing flag is what we've been using ever since for years in BFI Insights in the consulting sphere to basically help uh, cut down our long formulas. So, and everything that would learn from this webinar would be around trying to understand how this work and getting other hacks that would enhance your financial model. I think the next thing on my agenda here is to just give us a sneak peek of who our host is, the person of Promise Goldbold. Promise is a highly skilled professional who comprehends the value of modern accounting and finance tools. He recognizes the significance of equipping accountants and finance professionals with business intelligence tools to enhance their daily routines. With over 10 years of experience in Microsoft Excel, financial modeling, project finance, particularly project finance modeling, corporate finance, valuation, and financial analysis, Promise firmly believes that financial models can significantly facilitate informed decisions at every level of an organization. He serves as a lead trainer at BFI Insight, a reputable training and consulting firm dedicated to empowering individuals and organizations with data driven financial insights. Promise's proficiency in financial modeling has enabled him to develop exceptional models and create rolling forecasts for top clients and institutions worldwide. Additionally, he holds a certification as a certified financial modeling and valuation analyst, a certified Zero and QuickBooks advisor, and a data dear expert. In addition to this, Promise is a chartered accountant and also a lead trainer with BFI Insight. Promise and BFI Insight are committed to cultivating world-class financial analysts, empowering individuals and organizations to make data-driven decisions that foster growth and success. So we tend to see that our instructor, who happens to be our host, is someone with good knowledge of financial modeling, and he has been doing this for more than a decade now. So this webinar is nothing short of value. I'd just like us to just have a feel of how people have basically joined us across the globe. You all have responded across the globe. We had people from the United States, from Cameroon, from Cote d'Ivoire, from Pakistan, United Arab Emirates, who have actually showed interest in this webinar. So currently, it's actually a global stuff, kind of, and we hope that you gain value for your time and resources you've committed in joining this webinar. As I said earlier on, the webinar is around timing flags, cutting down lengthy formulas with timing flags. And at the end of this webinar, I'm sure that your objective and your reason for joining this webinar would have been met by all the nuggets, values, strategies, tools, and resources that will be furnished in you. Without further ado, permit me to welcome on board, I won't say stage, welcome on board, Promise Gold Board. Promise, you have the stage now. Then I would like to stop sharing, then you can share at your own end. Promise, are you there? Okay, Promise.
Yes, I can hear you, Justice. Hi, everyone. Good evening. Um, Good evening from Nigeria, Lagos. How is everyone doing? I hope you are doing well. It's a pleasure to host you today on this interesting topic, cutting down lengthy formulas and enhancing financial modeling with timing flags. So let's, without wasting of time, I want us to go into this, and my approach is going to be very easy. So what I intend doing is that I'll run you through some slides, then I will show you a typical financial model based on fast standard. Then Justice will send in a start file we are going to use to build a timing flag, right? And this timing flag, we are going to build it systematically because I'm going to take my time to break it down bit by bit so we can be able to understand how it works. And the timing flags we are going to be building is so great that it's very dynamic, right? So if the timeline for your model is 10 years, 20 years, immediately increase it or you change the value, right? The timing flag will automatically adjust to it. Now let's get into it. So basically, timing flags are part of the core architecture of any financial model, right? So I think before I proceed, does anyone have any question, if I may ask, before I proceed? But I think the best approach is that I would advise that we just hold on to our questions. At the end of the section, we're going to have a question time for us to be able to ask our question and also get answers to our question. As well, we are recording this, so you're going to have the recorded section as well. So back to timing flags. Timing flags are part of the core architecture of any financial model. Now, when we're talking about financial model, we are talking about financial model based on the fast standard, right? The same way accounting has a standard, which is International Financial Reporting Standard, and IAS, which is International Accounting Standard. The same way financial model has a standard. And the idea of the fast standard is that when you build a model, right, and you send it to someone in the United States or anywhere in the world, and the person knows how to use the fast standard, the person will not call you asking you to explain what you did. Another advantage of the fast standard is that you can build a model as a group, right? So probably someone is dealing with the operating revenue, someone is dealing with the operating cost, someone is dealing with the debt schedule, someone is dealing with the equity schedule, right? You can build that as a group. That's the beauty of fast, right? And we're going to be saying that. So timing flags are part of the core architecture of any financial model. Timing flags give every calculation the intelligence around when key events are happening. Now, the reason why you have lengthy formulas in a financial model is because of you are adding the how much and the when. Are we together? You're adding the how much, that is the value, right, of a line item, and when that line item happened. And sometimes you go ahead to add also the growth rate inside the same formula, making the formula very long, right? Those things makes the formula very long. So if you can be able to model a time flag, right, and as well model escalation factor, which is your growth rate or your inflation rate, then you now have the value, which is basically the amount. Then your formulas will definitely be short. Now we have two things. We have two questions to ask for each line item. So anytime you're modeling a line item, it could be revenue, it could be cost, it could be expenses, whichever line item you're modeling. It could be assets, it could be debt schedule. it could be your senior debt, it could be your equity, it could be your asset. You have to ask yourself two questions. The first question is the how much, and the second question is the when. Now, the when now deals with the timing flag. So the when is this happening? For example, right, in a financial model, let us use a project case financial model, right? So before the project commences, right, you're going to have the pre-forecast. Now, when you meet up to the term of the debt or from your investors, right, you have signed up the debt, the term sheet, and you have agreed on how much, and your bankers or your financiers have agreed on the amount, and everything is fine. That's the financial close. Then the operation should be able to kick off the next month or the next period, right? So that means you're going to have a pre-focus period, you're going to have a financial close period, you're going to have a focus period, and you're also going to have a post-focus period. That means if that project is supposed to last for a period of 20 years, right? That means at the end of the 20th year, going forward, you're going to have the post-focus period, right? So now, if you're modeling the revenue, it will not make sense for your revenue to enter in your pre-focus or your financial close or your post-focus. You only want your revenue to appear within the focus period. Okay, so if you want your revenue to appear within the focus period, then you need time flags. Okay, now for timing flags, a flag can either be 0 or 1. Now, what does that mean? 0 means nothing is happening, right? And 1 means something is happening, right? So if you're modeling a timing flag and you have 1, that means 1 means something is actually happening, but 0 means nothing is happening. Okay, now we have 5 types of flags. Now, across the globe, this is the only type of flags you have. We have the first one is that period in which a particular event occurs. For instance, your financial close. So your financial close is going to happen on 31st December 2023. That is a particular period. That is when the event is happening. Okay, the second one is period before a specific event, right? Now that is dealing with the pre-forecast, right? It's dealing with the pre-forecast, right? So before a specific event. So if your financial close, if you're, let's say, for instance, your focus period is starting from, let us say, March, right? And your model started from December. That means your pre-focus period is from December till up till 31st or 28th of February. Okay. Now, the third one is period after a specific event. Period after a specific event. Now, this could be post-focus. Okay, this could be what? Post-focus. So in your post-focus, that means your focus is done. Then that is your what? Pre-focus. That's after a specific event have occurred. Then you have the third one, the fourth one, I mean, which is periods in between 2 dates. Right? Period in between 2 event dates. Okay, so this could be your focus period. So your focus period falls in between dates. Okay, so that is the way that also work. Now we have the last one, which is basically recurring events. But for this webinar, we are going to focus on we're going to focus on 4. Then for the recurring event, if you have the opportunity to go to our course on financial modeling for business or financial modeling for projects, where we dissected this, then you can be able to get hold of that. Because of time, we'll just focus on this 4. Now I'm going to show you. I'll stop sharing now. I'm going to show you a typical financial model, right? So we're going to review this typical financial model within 5 minutes. Then after that, we can now start modeling the time flags. So I'll stop sharing now. Then I'll start by sharing that. Just a minute. So now